Welcome to the Independent Advisors Podcast, where we dive into the world of stocks, tradable markets, and financial planning with Jessup Wealth Management's Chief Investment Officer, Mark McEvely, and CEO, Matt Jessup. You'll hear tips, tricks, and strategies to address your financial well-being, and most importantly, conveyed in a way that everyone can understand. Here are your hosts, Mark and Matt.
Welcome to episode 365 of the Independent Advisors Podcast. On today's show, we're covering a few timely and important topics, including the bond market, companies raising their guidance, 2026 defying a normal midterm year script, history of the 401k, and household leverage. Whether you're tuning in for market insights, planning tips, or just staying informed, there's something for you. Today, it is me, Aaron Cramer, and Mr. Nick Whitaker here, so a little bit different than our normal Matt and Mark podcast hosts, but I think we've got some good topics here, and it should be a good podcast.
Indeed, yes. Our leaders are out of the office and traveling, and we're filling in, so it's good to be here, as always.
Absolutely.
So we're going to start, as we usually do, with some pricing, and this data comes from Y-Charts as of yesterday. Let's see, the S&P 500 is up 2.5% month to date and 12.2% year to date. The Dow Jones is up 1.9% month to date and 11.2% year to date. The NASDAQ Composite is up 3.0% month to date and 12.4% year to date. The iShares Russell 2000 ETF, think small caps, is up 2.7% month to date and 21.4% year to date. The Vanguard FTSE All World ex-US Index is up 3.5% month to date and 16.6% year to date. Checking in on the Treasury market, which we're also going to talk about here in a second. The 3-month Treasury rate is at 3.85. The 2-year Treasury rate is at 4.19. And the 10-year Treasury rate is currently sitting at 4.66.
Good. A very strong year.
Yes. All numbers that I don't think anyone's complaining about.
Not at all.
When you're
seen a lot of strength in the risk-on areas, the small caps and international. So very cool.
And small caps, 21%. Again, to remind listeners what we just went through. So typically, as you just mentioned, a risk-on area of the market, which is nice to see.
Absolutely.
So moving on to big headlines and current events, we really just have one. And it's the bond market. The bond market was a pretty big story last week. The 30-year Treasury yield briefly hit about 5.34 last Tuesday, which was August 18th. Its highest level since 2007. The move was significant enough for the Treasury Department to announce a double planned buyback of certain 10 to 30-year Treasuries from $2 billion to at least $4 billion per operation. So how does this work? The Treasury is basically going to go into the secondary market, and they're going to buy some of the previously issued bonds before they mature. The Treasury basically will then create demand for these bonds. So for listeners, just remember price and yield are inversely related.
Yep, exactly.
So as the Treasury goes in and they buy those bonds that are kind of out of date bonds, they're going to help drive some of the yield down, which will kind of help clean up the book, so to speak. So they're going to be targeting tickers that are called off-the-run securities, which are older Treasury issues that aren't as actively traded relative to the newest benchmark securities. So by doing that, they're basically just going to help some of the liquidity in the market and kind of get things a little smoother.
Get things moving, yeah, absolutely.
And the last piece here that we want to cover is that the Treasury can't simply create money to purchase the bonds. So if the Treasury spends $4 billion buying bonds back, the money ultimately has to come from somewhere. We can't just print the money because that would increase inflation, right?
We can, but we shouldn't.
We can, but we shouldn't. And so what's going to happen is the Treasury has specifically noted that all else equal, each dollar of buyback has to be financed by new Treasury issuances.
Yep.
So
you issue more debt.
Yeah, they're going to go out and buy the old stuff, and they're going to kind
of
retire it and reissue new things. And in that process, hopefully kind of tamp down some of those yields.
Yeah, it makes it a little bit cheaper for them and creates liquidity and just kind of makes things run smoother over the long run. They've got two objectives: inflation at 2% and liquidity in the bond market. So and full employment. So
Yeah.
three objectives really.
Yeah.
But
So, we'll see how that goes, and the market will certainly be tuning into the long end of the curve. It's been a lot of talk, and I'm sure people have seen items in the news about that.
absolutely.
So, moving on to articles and research from this week, the first thing I have is a blog post from Charlie Bellello on August 18th. It's a great post, and it's about the net share of companies raising versus lowering guidance. Okay, so what is guidance? Many of you listening will know, but I'll just go through a quick refresher for anyone who doesn't. Every quarter, companies come out and report their earnings. That's what they did in the past. What did they achieve? How much revenue did they report? What was their bottom line, et cetera?
Report all their financials for the prior quarter.
Exactly. Most of the time, not always, companies don't have to choose to release guidance, but most of the time, companies will, at the same time they're reporting earnings, they'll give you guidance. They'll tell you what they think their next quarter's earnings are going to be, what they think the full year's earnings will be. And oftentimes, stocks move more on the guidance than what just happened. We see it all the time, right? A company comes out, they had a great quarter, and they blow out all their estimates, and then they tell the market,
but we're nervous about
we're a little
quarter.
nervous about your year-end target. We're actually going to cut our year-end target 5%, and the stock moves lower.
Yep.
The market is always forward-looking, and so that's why guidance is so important. So this chart that Charlie has put together, it's a chart that goes back to 2022. We'll throw it up on the screen for everybody, and it shows that the net share of companies raising versus lowering guidance, that is moving higher. So that ratio is moving higher, which is a very positive thing. When more companies on the street are coming out and saying, "Hey, our guidance numbers are going higher,"
they're optimistic.
They're
on
optimistic,
their business,
yeah,
right?
We love it. So that's the first piece I have. Do you have any other comments?
No,
on that?
that's awesome. It's there's a chart. It'll be in the show notes. Pretty stark increase from 2025 and moving higher here. So it's awesome. So I think it's a wonderful sign for the the market.
And speaking of, I'm going to jump in and just kind of go off script here for a second, because we didn't mention this in the big headlines and events, and I probably should have. But NVIDIA reported earnings last night. The earnings were pretty good. I haven't dived.
It's probably going to go right in line with this.
And it looks the pre-market right now. Again, this is 8:27 at 9:15 a.m. So the pre-market, NVIDIA is up 6%. So I haven't digested the earnings report too much yet, but everything that we saw was pretty good. So just goes to show you that the guidance, the earnings
is not false.
Yes, indeed. So the second piece I have is it's a X post from Ben Carlson on the 19th of August, and he says the following: "My most contrarian take right now is that I'm not worried about the U.S. government debt crisis."
I love this, by the way.
Yeah, this is a fun one. And this very much relates to the current events with the Treasury market and the Treasury kind of going out and trying to lower the long end of the yield curve because they're worried about the debt and things of that nature. So Ben says, "My most contrarian take is that I'm not worried about the U.S. government debt crisis. We have the biggest economy. We have the reserve currency. We have the most rich people. There is no substitute for treasuries. We'll just keep spending and people will complain, but no crisis will occur. Maybe I've been wrong, but people have been predicting this for over a century and they've always been wrong." And that last piece is one of the things that I want to highlight.
Yeah.
And I'm sure listeners remember the talk of the debt crisis and the U.S. government is carrying too much debt.
It's been an issue for decades at this point.
It ebbs and flows in the headlines. We were talking about this, I know for a fact,
it was a very big
4
topic,
years
yes.
ago. It was a big topic in the
2022.
headlines, and people are worried about it and comparing it to Japan, and it was a big topic in the market. And there are some out there. Ben is one of them. I think we're a little bit more in this camp as well, generally speaking, in that
we're probably just going to inflate it away. To be honest with you,
yeah.
I mean, it's what we've been doing for decades now. Is that unless inflation doesn't happen at all, it's pretty much a non-issue because the debt gets bigger, but we inflate our currency, and and costs, and it evens out, right?
And it would be different if we weren't such a big economy and the reserve currency.
The reserve currency is a big kicker there. I mean, honestly, if a couple of those went away, it's a bigger issue, but
Right.
I don't see that happening. So
And the Treasury
I
market,
tend to agree very much with Ben on most things.
Mhm. And the Treasury market, the reason he singles that out as well is the Treasury market is thought of as a safe haven for the entire global financial system.
Yeah.
So if you're an investor and you're in any part of the world and you're really, really, really nervous about something and you don't want to just park it in cash, you want to put it in an asset, you're going to go buy treasuries.
Sure.
And so that's another big piece of this. So very timely post by Ben, and
Always. He's
we
always got
like
good stuff.
Yeah, we like his research. And we
I got
appreciate
another
that
piece by
one.
him too, so we're doubling down on Ben today.
Excellent. I love it. So my last piece here is a post from Astra Insights on August 13th. And it says 2026 continues to defy the typical midterm year script. The S&P 500 is currently having its third best midterm election year through this point in the calendar since 1950, trailing only by 1954 and 1958. It is also running well ahead of the average midterm year path, and notably, the only 2 years ahead of 2026 at this stage both went on to finish the year substantially higher.
I like that.
Yeah, it's great. So, and we talk about this a lot, but generally there's some weakness in the midterm year. And there's a chart that we'll throw up and you can kind of see the average, and the average is relatively flat. It kind of goes up a little bit towards the end, and you can see all these different years in gray, and then you can see this 2026 in red. And it's obviously very nice to see because the market's doing better than the historical data
norms, right?
would suggest.
Yeah.
And this is a perfect example of why we say, history rhymes. It doesn't
repeat.
Sometimes, people will say it repeats, but it more rhymes, and why we use a historical lens to help guide decisions, but we don't use it strictly to invest, right?
Sure.
It's helpful
it's
data.
a data point, but it's
a data
not
point.
something to bet the farm on, right?
And this is an exact reason. If you were saying, hey, you know what, I'm going to go do a huge reallocation shift because the midterm is going to be flat, and I want to go somewhere else in the market, you would have been wrong. And so
to this point, yes. Yeah.
Yes, to this point, yes. So that was my last piece.
I love that. That's encouraging. Again, it's a data point, not it's kind of softer data for me. I want to see what earnings look like and fundamentals. That's the important stuff, which have been very, very good this year. So
that always helps.
Really, I think it really does. It's I think this year's probably different than a normal midterm year because of the hyperscalers and the investments in AI. A lot of that's trickling down to many of the companies in the S&P, and that's why we've seen earnings reports been so good.
We wanted to take a minute and tell you about a service we personally use and trust, LifeLock by Norton. With everything we do online these days, protecting your identity and personal information is more important than ever. That's why we've partnered with LifeLock, a leader in the identity theft protection industry. Their mission is to empower people to live their digital lives safely, offering tools to help protect you and your family from threats like identity theft, cybercrime, and fraud. They combine advanced technology with 24/7 support to keep your information safer in today's connected world. We use it ourselves, and we think it's a valuable tool for anyone looking to add an extra layer of protection. If you're interested in checking it out, you can use our special link to get a discounted rate. As a heads up, we do receive a percentage of compensation if you sign up using our link, but we partnered with LifeLock because we believe in what they offer. To learn more and get the deal, just head to jessupwealthmanagement.com/LifeLock.
So moving right along, if you're okay with that.
Absolutely.
All right. The first piece I have is by Ben Carlson from his blog, not his Twitter or X. It's titled, "The 401k has been a success." And this is from August 21st. So I just wanted to highlight a few points that Ben makes and, go over a couple history items of the 401k plan and when that started. So
that's
fun facts, right?
Yeah.
Fun facts if you're a nerd like me. So here's a brief history of the 401k plan. The Revenue Act of 1978 included an obscure provision called Section 401k, which offered employees the option to defer taxes on certain types of compensation. So that's where the term 401k plan comes from, is that provision name. In 1981, the IRS created rules that helped clear the way for employees to contribute directly from their income into the 401k plan. So that's kind of when it really started. The provisions were set up a few years prior. 45 years later, more workers are now on their own when it comes to saving for retirement versus pension plans, which were historically more common. So for people that may not understand what I'm saying here, a 401k plan is typically a self-directed. You're going to have some investment options that you can select from your own or some default investments. And it puts the onus on the employee to save and invest with maybe some company match or profit sharing, things like that, versus a 401k or a pension plan, which was fully funded by the company based off earnings, age, things like that. So it puts the investment responsibility on the employee versus the employer. So that's what Ben's talking about here. I just grabbed a few highlights of the history. So not a very deep dive, but we could probably talk for hours just on the history of it. So where we're at today, assets in defined contribution plans broke the 1 trillion mark for the first time in the mid-90s. Today, there's something like 12 trillion in defined contribution retirement plans. So that's a big number.
That's incredible.
And these plans are only getting better features. So there's now defaults in most of these plans that put workers into diversified target date funds. I'll say to those, but some plans allow participants.
Talk to a financial advisor if you're in one of those, please.
Some plans allow participants to automatically rebalance their portfolios and auto increase the amount saved per year. Love that. That is a great addition. Plus, these contributions come out of your paycheck before you ever see it, before it ever hits your bank account. There's that psychological, if you don't see it, you might not touch it, and that really works. And there's a cool chart that he puts in the blog, and it shows more Americans own stocks than ever before. So it's a little over 60% of Americans own equities or stocks right now. And that could be in an index fund, a target date fund, could be in any of the mutual funds that might be available in your 401k plan. But I think that's a pretty awesome stat, because just looking at 1983, it was less than 20% of Americans own stocks. So I think the theme here is that the 401k plan is working. Does it put more pressure on the employee to save and invest? Absolutely. But the last few points here that I really love that Ben makes is there are still far too many workers who don't have access to a 401k plan. More than 30% of workers have no retirement plan option through their employer. Could be a small business, could be just the industry. Here's what I would do to improve the U.S. retirement system. Give anyone who earns a paycheck access to a retirement plan run by the government. Think thrift savings plan, which is typically you see with federal employees, military. He thinks it's one of the best retirement plans ever created. He says there's just 5 funds in the plan. All of them are index funds. The cost for each fund is 5 basis points or less. There are also target date fund options that utilize a mix of these low-cost funds. Anyone who wants access to the retirement plan should have it. And if your employer doesn't have a retirement plan, you should be automatically enrolled in the TSP. If you don't want to save, you can opt out. Don't like your employer plan, you can have access to the TSP too. I think that's a really, really interesting idea and topic. Don't see it coming to fruition because that's expensive. Yeah, expensive to administer and maintain. And it's almost like maybe kind of a replacement for Social Security or in addition to Social Security. So when you open it up to everyone, it just gets more complex. And
for sure.
I don't know if you've ever been on the TSP site, it might break it. So just a really interesting idea. I love the idea, and I think it's cool that many people now own stocks and are participating in the equity markets. And it's going to kind of go hand in hand with my last piece here too, and talk about it. So
I think that's my biggest takeaway from this is, I mean, his idea is great, but it's like anything else.
It's a little dreamy.
It's an idea with government,
Good luck.
Yeah, good luck. But
you're gonna have to fight Fidelity and Vanguard on that one.
Yes, you are. $1 trillion behemoth companies. But the more Americans owning stock than ever is really interesting. I was also surprised to see that the overall percentage didn't drop that significantly after the great financial crisis. GFC. I would have thought that it would have dropped more, maybe 10% or something like that, but it really didn't, which is, pretty good to see. I think from a psychological perspective.
Yeah, I think it shows that people kept contributing. They kept doing it, whether they, I guess, were aware of it or not. They were buying into it.
It's good,
which is awesome. And I think that's probably why we're above that 60% mark, is because, one, they've gotten so much more popular, and I think people have started to trust them more over the last decade. Because I've heard in times before, whether it's employees that just don't understand it or don't trust it, they don't want to lock up their money. I get that, but we've seen them work really, really well, and it's the most common solution right now for retirement. So if you have one, use it, get your company match, participate in it.
At a minimum, get your company match.
Long term, it's not a day-to-day, check it every day kind of investment. It's do it for 20, 30 years, and you'll be happy you did, my opinion.
Absolutely.
All right. Any other thoughts on that?
No. Take us along to Mike Zaccardi.
I got the good Mike Zaccardi, ex-post on August 23rd. And this is really it's just a chart showing U.S. household leverage. Liabilities to net wealth is the lowest in 50 years, according to J.P. Morgan's research. Really interesting, because I think it's kind of contrarian to what we would feel in media and news with inflation being elevated, and obviously it's more expensive for people to go to the grocery store, get gas. I think I have a really short explanation for this. U.S. equities have done really well the last decade. Housing market's up.
I was gonna say
that's all there is. I just wanted to point that out, because this is a little it's like a little softer point. It is what it is, and I think it's a pretty easy explanation.
Yeah, I think it can almost be a bit of a misleading stat.
Exactly.
A little
it
bit
doesn't dive into what the consumer might actually be feeling or experiencing.
Yeah, because net worth and liquidity of a household are two very different 100%.
Things. There could be a lot of money locked up in home equity or in a 401k plan or assets that aren't liquid, right? So that's my explanation for this. I don't have that much else. I just wanted to point that out.
Yeah, not to discount the chart or anything, and it's a good chart and it's interesting, but I do think that's the first thing that jumped in my head was
the market's done so good. If you
look
at this chart coming off the GFC and the housing market, it just makes complete sense to me. Yeah. Is it super low historically? Yes. It's not the lowest we've seen ever, but it's pretty low. I would love to see it continue to trend that way, but we shall see.
I would love to see the data behind the data.
For sure. Where's JP Morgan getting this data? Is this a survey? Where are we really getting this here?
Yeah.
Okay. I got one more for you. This is another ex-post by the Kobayashi letters on August 23rd. It is about S&P 500 dividends versus U.S. Treasury. So I thought this was really interesting, very Treasury-heavy podcast today, but that's okay. So the post says, Treasuries now offer more income than almost every S&P 500 stock. Just 3% of S&P 500 stocks now have dividend yields higher than the 10-year Treasury note yield, the lowest proportion since May of 2007. This marks one of the lowest readings on record in data going back to the early 1970s. This percentage has declined negative 40 points since the start of 2022. By comparison, 63% of S&P 500 stocks had a higher dividend yield than the 10-year Treasury note in July 2016, an all-time high when excluding the 2020 pandemic crash. To put this into perspective, the long-term average since the 1970s is 18%. The bond market situation is historic. So
it is
very historic. We're seeing pretty elevated yields in Treasuries, and I would also say that I don't know this stat. How many companies in the S&P at this stage are paying a decent dividend? It's I think dividends. If
I don't know that stat,
I don't know that stat either. Probably should have looked that up. That's okay. I think the theme here is that the Treasury yields in the bond market are very elevated, and looking back at history, not that elevated, because if you look at this time period from the 70s to, I don't know, what is that, 2007?
Yeah.
We're not that far off. I think it's just people got used to ultra low yields, and I think the outliers are the early 2000s, 2008 to 2022 are the outliers, right? So I don't know.
Agree.
I don't know why we're putting so much emphasis on it and why it's so historic. But is it low? Yes, but is it? I think 63% of stocks in the S&P 500 being higher yielding than in 2016 is the history, not today, in my opinion. So
yeah,
I don't know. I'm not putting that much weight on what the bond market's doing right now. Is it different than it was 5 years ago? Absolutely. But is it a reason to panic?
No, don't panic. For sure. Stay calm.
It just gets so much media attention right now that I just wanted to highlight it. I don't think it's a reason to. Do you want to be in corporate bonds right now? Probably not. But there's a place for it, right?
It depends on the corporate bonds too. I mean, because the corporates, some corporates will be,
significantly
higher and trading at pretty good levels. So there's an appetite for a certain type of investor. But I don't think that the Treasury market, especially when you look at this chart, right? Like you pointed out, the 70s, the 2008 to 2024 was really more of the outlier, I think, on this chart.
Agreed.
And I know Matt and Mark have talked about it. We've talked about it. The Federal Reserve setting interest rates where they are, in the mid threes, and a lot of the media acts like that's so high. Oh, it's so high.
It's high relative to 2020. Right?
Exactly. It's high relative to the ultra low interest rate environment that we've had, generally speaking, since 2008. Now the Fed did go up and down a little bit,
but not much.
But not too much. But when you look at the Fed funds rate as it pertains to the history, 2-3% is pretty normal. And when the Fed fund rate is in 2 or 3%, then the interest rates are going to be higher across the market.
Sure,
so
because there's that spread.
Exactly. So in all, I don't think investors and listeners should be too worked up about the reports that they've seen on the bond market and things of that nature. So.
Agreed. All right. I got one last thing. It's the financial planning topic of the week. I wouldn't really call it a planning topic. It's just some news regarding some push to make 401k and IRA rollovers simpler, which would be phenomenal.
Yeah, we're here for that.
So I'll just kind of read through this article. It's goes on to say it's guidance released by the IRS, so it's some very fun light reading here. But new guidance would encourage electronic transfers and standardized forms for moving retirement savings between plans. I think that's important to point out because every plan can have their own form. They could have their own process. It could be paperwork. It could be online. It could be phone call. It could need a trustee signature. It could be whatever they want it to be. They can make it as challenging as they want. I digress. The Department of Treasury and the IRS have proposed a new process intended to make it easier for Americans to move retirement savings from one plan to another. The guidance issued in IRS Notice 2026-49 under the Secure Act 2.0 of 2022 includes standardized forms and procedures for rollovers, including workplace retirement plans and some individual retirement accounts. The goal is to make rollovers faster and more consistent across financial institutions. Under the proposal, retirement plans would communicate more directly with one another instead of relying on participants to manage much of the process of moving an account themselves. Plan sponsors would be encouraged to use encrypted communications, a unique identification number for each rollover, and electronic fund transfer for moving assets whenever possible. I think that's huge because we see with some of the really big plan administrators that they're still going to send you a check in the mail to your address of record. Then it's on the client to send that check to their other institution. And there's just a chance that check gets lost, misplaced, held on to too long to where it's not valid anymore.
Not to
and you're
mention,
out of the market for 2 to 3 weeks, right?
And the stress of, mailing
I've
a
seen
check
$3 million check
of your
before.
life savings.
$3 to $4 million checks I've seen
There's
before, and it's
definitely
not
some stress
a
there.
fun feeling.
It's not. I've done it myself. It does not feel good.
The changes are aimed in part at reducing the use of paper checks. A 2024 Government Accountability Office report cited by IRS and Treasury, the IRS and Treasury found that nearly 1/3 of participants surveyed received paper checks. I bet it's higher than that.
It wouldn't surprise me if it's higher than that.
Especially in the 401k qualified plan space. So goes on to say, if an electronic transfer is not available, the proposed process calls for a check to be made payable to the receiving plan and sent directly there. Love that.
Yeah, that's
Save a step. Why
save a
not?
step.
Rather than to the participant. So for now, the use of new forms and procedures would be voluntary. Treasury and IRS are also considering additional rules that could further restrict paper checks and require electronic transfers when plans have the technology to complete them. So there's going to be more agency proposals and comments through October 23rd of this year. So yeah, I think that's a good piece of financial news and potential change that could come. We'll see. This part of the industry has been very slow to adopt technology. The fact that we're still sending primarily paper checks between qualified plans in 2026 is insane.
Crazy.
When we can Venmo our friends in 30 seconds and send money between bank accounts with, it's just... I get the sensitivity and the protections needed in this, especially in larger dollar amounts and retirement savings. But I think making a push electronic is a very wise and, should make it easier for participants to not abandon retirement accounts and leave them in old plans when there might be better options elsewhere. So I think it's a good thing. Very much so.
Yeah, it's a fantastic thing. So hopefully it,
we'll see. We'll see.
It gathers some steam.
Again, there's lobbyists to deal with. There's giants in the industry that have to be appeased. And we'll see. Hopefully it comes to fruition. I bet we're still several years before it's standard practice.
Unfortunately, change takes time, right?
Absolutely.
So, but worth it nonetheless. So, you have anything else for listeners before we sign off?
No, that's all I have. Anything you have?
I don't.
Awesome.
So,
Well,
thank you all for listening to episode 365 of the Independent Advisors Podcast. Catch us next week for episode 366.
Thank you for listening to the Independent Advisors Podcast. If you're interested in hearing more, hit the subscribe button so you can be notified every time a new episode gets released. Feel free to share with friends, family, and follow us on Facebook, Twitter, LinkedIn, and X. Mark and Matt will continue to share beneficial information on these social media sites. Also, check out the podcast tab on their website. That's www.jessupwealthmanagement.com. There you'll find links to every episode of the Independent Advisors. Have questions or topics you want to discuss on the show? Send an email with the words questions and topics in the subject line to inquiries@jessupwealthmanagement.com. We'll talk about it right here on the podcast. Certain sections of this commentary may contain forward-looking statements based on reasonable expectations, estimates, projections, and assumptions. Forward-looking statements are not guarantees of future performance and involve certain risks and uncertainties which are difficult to predict. All indices are unmanaged and are not available for direct investment by the public. Past performance is not indicative of future results. This podcast is provided for general informational purposes only and does not constitute either tax, legal, or financial advice. Although we do go to great lengths to make sure our information is accurate and useful, we recommend you consult a tax preparer, professional tax advisor, financial advisor, or lawyer regarding your specific circumstances. Investing involves risk, including the loss of principal. No strategy can guarantee any objective or goal will be achieved.